Hello traders, what's going on? So this is a ad hoc market update video because a lot of craziness has been going on in the market. So without any further delay, right, let's just jump right into it. So firstly, the US S&P 500 US market has been on an extremely aggressive rally for the past 2 weeks. And in fact, we only see 2 rate days within the past 14 days, 14 trading days. And in fact, within the 2 rate days, right, one of the rate day is like can be considered green because market eventually did recover here. The only true rate day we have is here, this particular red candle here. So from the bottom itself, S&P actually recovered close to, I believe, 13%. Yeah, close to 13%. And more importantly, we do want to look at the overall structure of the chart itself. It break through the resistance at 2620 level or 2600 level. 4600 level. So it's much more a nicer number lah. So we think of it at 4600. Okay. So another thing is that this level is quite important because previously it was a lower high. So now it has broken through the lower high already. And even if it does retrace from then on, right, S&P have successfully created a higher high here lah. So when it does retrace, we want to see whether it's going to create a higher low where you can start adding more longs to ride the trend up, or who knows, it will just dive right back down here. So no one really knows what will happen, but there are a few factors that is contributing to this recovery itself. Firstly is because the beginning of the rally, which was the 16th March, it was the FOMC announcement for the new rate hike, and they raised the rate by 25 basis points. So this is something I covered in the previous video already, so I don't really want to go through it, simply because the market now have a much more certainty, a much more direction of what the FOMC is going to do, and then it seems that the 25 basis point is quite bullish for the market. It's not like front loading 50 basis point like that. So market went up. But recently, there has been also talk about potential peace, potential war ending in the Russian-Ukraine conflict. And if you look at the news, we do see about yesterday, there are some talk about peace negotiation in Turkey, and Moscow said that it is going to curb the assault on Kyiv, and Russian troops have been seen withdrawing. So even though the actual peace treaty or negotiation is somewhat not really optimistic. I mean, on one other news, I read something like they wasn't able to come to a conclusion, but one thing for sure is that now we at least have some physical evidence that we actually see Russia troop withdrawing from Kiev. But of course, there are some news that say US official warn Russia troop movement is not a withdrawal, but who knows. Okay, but at least from the market perspective, the physical evidence of seeing Russia troop withdrawing is a good sign because previously all we hear is like whatever going on behind the scene, hearsay here and there. We don't really have concrete evidence, but now we do have some concrete evidence. So the market kind of take this as a bullish, and then it kind of rally within the past 2 days. But contributing to this rally, we also have another culprit, which holds a very big weightage on the S&P 500 itself, and that is of course Tesla. Tesla recently announced the potential stock split. Do be reminded, the word is potential, so not a confirmed stock split. So the market respond very well to the news, and it gaps up and is even closed higher yesterday. Even though it's a red candle, it's still closed higher compared to the Monday closing. So let's take a little bit closer look at the Tesla news. Okay, so Tesla want to split its stock so that it can pay stock dividend. So this is I'm not sure what's going on. Like why on earth will they want to pay stock dividend? Because if you look at Tesla back in 2020, 2 years back, they are facing cash flow issue, and it was Elon Musk was desperately trying to find buyers to privatize Tesla. If you guys can remember the news back then, there was some big hoo-ha. We will come to that later also. Okay, so Elon Musk was desperately trying to find someone who is willing to buy his Tesla company. And in fact, Tesla back then was actually surviving a lot on government EV subsidy lah. But somewhere along the way, they managed to turn a quarterly profit. They managed to turn one of their quarter to be profitable, and since then they successfully ramp up their manufacturing, and now they are delivering like record-breaking level of their EVs lah. So that's a good thing. So I guess they wanna reward those long-term holders, and they want to encourage people to hold on to the Tesla. But in order to do that, right, I mean, they must be very confident in their current cash flow, their current profit generation, that they can pay a stock dividend lah. But for me, right, I personally believe that yes, they want to do a stock split, but why on earth they want to stock split is a question mark. I think this paying of stock dividend is something that they just like conjure up. They just trying to find some reason lah. Okay, so I'm not sure, but with regards to this stock split, right, it is not an immediate stock split, because in order to enable the stock split, they need to increase the number of authorized share of the common stock. So they can't straight away do the stock split yet. They must first increase the number of authorized shares. So what's happening here is, let me just try to draw so that you can visualize. Imagine this is the number of shares that Tesla have. Okay, this is the number of outstanding common share Tesla have. So in order to do a stock split, they need to meet a threshold, which is this amount. Okay, they need to meet the threshold, which is this amount. But currently they have only this amount of shares. So even before they can do a stock split, they need to increase their number of shares to like this. Okay, so they cannot do that with stock split here. So that's like a bit weird. But what they can do is they need to do some form of share dilution. So when share dilution happen, right, it actually affect the pre-existing shareholder, meaning now the number of shares in Tesla increased, but the value of your share did not go up as well. So it is essentially dilution. Okay, it's like inflation on your existing common shares like that. So if you talk about share dilution, is quite bad for current shareholders. And the current shareholder need to accept that they are willing to get their share diluted. Only then the stock split can happen, right? Then of course that's what is going to happen. The shareholder need to accept that. In order to get a stock split, they must first willing to get their shares diluted. But regardless, I think the market doesn't really care what's going on. The moment they hear stock split, the Tesla share just went up, like how we experienced back then. Okay, how we experienced back then. Tesla went up all the way to $1,000 before. I think 1,006 before the 4-to-1, the 5-to-1 split actually happened. But the more trickier, the more suspicious thing is that news was released on Twitter. It wasn't released anywhere else. It was actually released on Twitter, and then after that, all the news channel, news outlet, when they saw this tweet, and then they start to advertise on their own news channel like Bloomberg, CNBC. But first, the news was actually released on Twitter, meaning when this news come out, right, there wasn't any like proper document yet. They just shared this news on Twitter, and the share price just exploded based on one tweet. So it's kind of funny how stock price are moving nowadays based on just one tweet alone. So eventually they need to hold an annual meeting in order to get approval from shareholder to dilute the stock first. Okay, they need to dilute the stock first, then after that they can split the stock. So the shareholder must approve to this dilution. But based on the share price movement itself, I think the most of Tesla shareholder might be agreeable. Who knows? Who knows? Uh, that's not for me to judge. There's no way we can analyze this kind of very sentiment value stuff also. But one thing I want to point out is that if you remember what I mentioned earlier previously, 2 years back, Elon Musk was desperately trying to find buyers to privatize Tesla. And there was a point in time, he tweeted that he actually found a buyer. And not only that, he tweeted that the final buyout price for Tesla is $420. So that was way back in 2020. And back then, Tesla price was somewhere around 350 or 370 like that. So the current price of Tesla was 350 back then. And he tweeted that the buyout price is 420. I mean that there's like no, it's like a very explicit tweet. He said that funding secured at 420. That was his actual tweet. You can actually Google it. So when he tweet that, right, it kind of relay the message to the market as Tesla confirmed buyout at 420. And of course, due to that, the share price went up. The share price shot all the way up. In fact, it shoot all the way up beyond 420. It was like going to 450 like that, if I am not wrong. And then a few days later, Elon Musk was questioned by the SEC because, like, I mean, it is almost as close as market manipulation. And then eventually, Elon Musk came out and said that, actually haven't confirmed yet, but he is in discussion and it's highly likely that this party is going to buy out Tesla at 420. So when he came out and said that, Tesla price crashed back down to like 350, 320, who knows, forgot already, but it does crash down quite drastically from the high of like 430, 440, that kind of level. And it was about 20 to 30% drop. Of course, I mean, eventually Tesla went on to get a profitable quarter and they went up to 1,600 and then stock split, whatever. So if you look at it from hindsight, right, that little scenario like doesn't matter at all. It's like a small ripple in a huge wave of Tesla rally. But imagine that you are a long holder during that period. Imagine you bought into the hype where Tesla is going to privatize at 420. You buy into the hype. You went on a very big long YOLO position, and eventually you see your stock crashing down by 20-30%. So if that happened to you back then, right, most likely you will not be holding your position in Tesla to enjoy the rally towards 1,600 pre-stock split back then. So what I want to say is that, yes, the hype is very real here also. There's a lot of FOMO going on. But even if Tesla eventually able to get everything approved and able to get like rally up to the moon or whatever, you might experience short-term volatility. Okay, you might experience short-term volatility. And if you are already holding position, be prepared for that. I do hope that your position is not so big. You have already managed your position in preparation for this kind of short-term volatility. And in terms of chart wise, it still have not break out above the previous high. So in a way, it can simply create a lower high and then start to come back down also. So I'm not trying to scare you, but I'm trying to give you all the possibility that can happen. And hopefully you are not that one guy that went YOLO big position on this gap up. And if you did that, most likely you might be in exposure to a big risk. So make sure that you have proper plan on what you want to do. Make sure you have a proper stop loss level. But if you have been in Tesla since like God knows when, very long time ago, or maybe even if you get in during the earlier portion of the rally, right, you are relatively more safe. You have a lot of unrealized profit that you can work with. You can lock in your profit somewhere, shift your stop loss. So even if it come back down, right, you already have locked some profit there. Or if it doesn't come down, continue to rally, then good, you can still ride the trend. So you have more power. You are in a position of power to play the stock, play this particular Tesla. But If not, if you bought in high here, then you might be exposed to short-term volatility. Okay, so please be very, very careful. Personally, I am not really in this trade because I do not really want to buy into the bottom here in terms of risk, right? To me, it's not really worth it. So I'll go through with regarding this together with my portfolio for data lah. So another thing is that let's take a look at Apple also. Apple is definitely one of the other big rally player. So in fact, we have seen 11 or 12 consecutive day of green candle for Apple, and each of the green candle is not like your small candle like this. Every day is like about 1%, 2%. And in fact, from the bottom itself, we have close to 19% rally on Apple. And in fact, this is quoting straight from Bloomberg. I did not do this research. The last time Apple have 11 consecutive winning days, right? It was way back where they haven't even created iPhone yet. iPhone wasn't a thing yet. So I think that's some trivia, that's some very interesting trivia. But Apple also announced something about decrease in production in China, I believe, or somewhere. I can't remember the news really. And because of that, it actually opened gaps down, but it just rallied up towards the end of the day. And yesterday it rallies up even more lah. So both Apple and Tesla are big weightage constituent of S&P and Nasdaq itself. So we are seeing very huge rally in the heavy weightage lah. Of course, there are also other supporter like Amazon, which also have huge rally from the low, and it has erased all the loss that they made during 2022 lah. So this is definitely very good. So and another way we can see why the current rally is actually the rally for past 2 days this week is more of the Russian and Ukraine conflict coming to an end. It is led by that particular piece of news. Is we can also see Russia conflict theme counters starting to drop. For example, when we look at Alcoa, this is the aluminum counter, which is went up by quite a lot due to the conflict itself, because the production is affected due to all the sanction or all these things that is going on with the conflict, right? You can see on Monday, price actually gapped down but recover, and on Tuesday, yesterday, it also gapped down but it managed to recover lah. But we are facing some selling pressure. We are facing a lot of gap down, even though it managed to recover eventually. And aside from aluminum, we also have the soft commodity sector that is heavily influenced by the Russian-Ukraine conflict. Also, we have Bunch Limited that gapped down quite aggressively, but eventually managed to recover before going below the previous low. Similarly, for Archer Daniel Midland, also it managed to recover before going below this gap here. Okay. So next, we also have the uranium companies, which gapped down quite drastically and then fell very low and eventually recovered towards the end of the trading day section. So there are some buying coming in within the session itself, but the immediate response was a big gap down. And we can also see this on the fertilizer sector. Mosaic, we can also see this. It has a very big gap down. Price go down a lot, but eventually recovers before creating a lower low. Then next one is all the LNG counters also. For example, like Coterra or Range Resources. We see how they gap down and then eventually close higher. Coterra, how they gap down and then eventually recover. Or LNG, gap down and then recover and close at the day high. So that is something very weird about the price action on this counter, and that is because it does seems like the immediate response to this news is sell down. It seems like the war is coming to an end, and all these companies, all these conflict-related companies might not be going to do very well like how it used to be. So there was an immediate response of selling down. But as the market progressed throughout the day, and as buyers and traders start to digest the news, buyers start to come back in. So that there seems to be a little bit of I would say, what's the word for it? Some fighting between the bulls and the bear, where the bulls and the bear for this particular team where maybe there are still quite a big portion of traders who believe that this whole peace treaty is like facade, not really gonna happen. Just say only don't really trust Russia withdrawing the troop or whatever. So there are still a lot of buyers coming in So if you have trades on all these counter, right? Most of my Patreon trader who should probably have trades on this counter, stick to your stop loss, stick to your trade plan. There is no need to panic over this kind of price volatility, because the stop loss that we have for these counters have already accounted for all these kind of price volatility. So your lot sizing should be managed in a way where this kind of price movement should not be scaring you. Okay, so that's basically for this portion itself. So let me be, I do want to talk about the yield curve also, but before I talk about that, right, I just want to briefly share my portfolio also, mainly because I want to make the connection between the price action and my portfolio, and how you can model your portfolio in a way where, like, whether the market is up or long, or whichever your bias is, right, you can minimize your loss, and you can always shift your portfolio bias into whatever the market is trending. So firstly, right, I want to point out that I am not a fan of bottom picking. I don't really like to bottom pick here, which is why you do not see me bottom picking things like Tesla or Apple. And that is basically how I trade. What I want is I want to see at least 3 months or 5 months of sustainable uptrend, or I mean, I must be able to foresee at least 3-4 months of sustainable uptrend before I start to buy. And one of the way that I look at that is by higher high and lower high. Sorry, my bad, higher high and higher low. So in this case here, right, in the current trend, we have seen 2 lower low, and we have seen 1 lower high, but we have yet to see a higher low. Okay, perhaps here we have a higher high already, but we have yet to see a higher low. So before I start to go into like a long bias, right, I do want to see a higher low, and then from there maybe I will see, okay, we can go into a long position. Excuse me, my bad. I was sneezing. I managed to mute my mic fast enough. Sorry, sneezing again. Yeah, so as I was saying, right, I must be able to see a sustainable uptrend before I decide to go for a long position. In fact, during the earlier portion of February and March, right, I actually start shorting somewhere around here, because I believe that we have a lower low. And when the market break through here, right, I believe that this was a lower high, and then of course market start to go back down. So I did not start shorting like right here or even right here, because that's simply against the trend. And likewise, in the situation right now, I think that making a long position here and here carry very, very high risk, where the market can just drop down like this. You will never know also, because back then the optimism, the general market sentiment wasn't very, very, very good. In fact, the technical was in fact pointing towards the lower side. But of course, back in hindsight, if we look at it, yeah, we could have gotten here, but it's not the kind of risk that we want to take. Definitely, if you are someone who caught the bottom here and managed to write this right, I would think that this is the kind of reward that you are getting simply because you took the highest risk. And I think that's something you definitely deserve it. A huge congratulations to you. But of course, from traders to traders, right, we all have our risk tolerance. We all have our certain place that we are more comfortable with. And for my case personally, right, I don't really like to make this kind of bottom pick plays lah. So just to kind of go through my portfolio a bit, I do have Google and MasterCard, but my portfolio overall is still slightly skewed towards the bearish side. I am still holding my short position on the children place, which is still in quite a good profit. Unfortunately, my Starbucks shorts have went into negative 300. It was initially somewhere around positive 1,000 or 2,000 like that lah. But I do not look at individual trade like this in my portfolio. What I like to look at is my overall portfolio, like as a whole, like one big basketball team. I don't look at individual players, but I look at how the portfolio perform as a one big team. So somewhere around 2 weeks back, before the market start to rally up aggressively, right? My unrealized profit was somewhere around $5,000 like that. So now after this big rally, my profit, unrealized profit dropped to 2003 lah. So I actually lost about $2,500 in unrealized profit. Okay, these are not actual realized loss, but I lost unrealized profit. if you kind of able to follow. So 2,500 from the perspective of my entire portfolio value, which is around 120,000 $120,000. It is a very I would say negligible amount. It comes out to less than 2% or somewhere slightly above 1.5% like that. I'm not really sure the exact percentage. So it's not a big reduction in my unrealized profit, and it's something that I can deal with. Okay, so what you'll notice is I do have quite a bit of exposure to the Russia conflict theme counter. I do have Archer Daniel Midland. I do have CCJ, which is the uranium. I also have the LNG, which is the liquefied natural gas. So I am quite exposed to the Russian conflict thing, but I kind of balance it out with Chevron shorts. So this is shorting on the oil and gas counter in order to buffer a bit lah. And I also have Google and MasterCard long position sometime during actually right after FOMC make their announcement. So that is to buffer for any kind of market rally that could have come in, and I believe that was a little bit of a good decision in the sense that without MasterCard and Google, right, my portfolio might have erased all the unrealized profit that I currently have so far lah. So overall, what I have is that some of my shorts are still in profit. One is slightly above the break-even point where it goes into negative already, which is Starbucks. But the rest of the position are still a little bit of rate doing quite okay, and Google actually leading most of the gains lah, because of the huge rally also. So what you can see is that given the aggressive rally that we faced for the past 2 weeks, and given the fact that my portfolio is slightly weighted towards the bearish side and the Russian conflict side, right? I didn't really lose a lot of money. In fact, I only lost unrealized profit about 2,005, which is a very small amount compared to the size of the rally that we have seen here. And that is because I was able to hedge off my position with Google and MasterCard. In fact, I had MasterCard way earlier. You can see it was like 139 profit. It was mainly back in early February, I believe. Early February, I actually, yeah, February 6th, I actually have MasterCard way back in February 6th. This trade setup was sent out February 6th, but I entered somewhere around here. So I'm kind of in a small profit right now. But of course, before that, it went into red for quite some time. My stop loss was somewhere around here. So both Google and MasterCard was able to buffer the current rally, and I was able to hold on to my portfolio without a huge volatility in price. So that's very important. I can maintain my portfolio position without my unrealized profit dropping into unrealized loss or like a huge swing. Okay, so that's very important in managing your portfolio in a way that you must be able to structure your portfolio where if you sense big events are coming up, right? And your portfolio is heavily weighted towards one direction, you must be able to hedge them out with corresponding position in a different direction. They might not give you profits, but what they can do is they can give you some options. I'll go through later, but they can also ensure that you don't lose so much money. So in my point of view, right, any loss prevented is actually equivalent to profit gain, because if you are able to prevent losses during huge market movement against your direction, and eventually when the market start to trend and when you are able to play with the current market direction trend, right, what you can do is all the loss that you have prevented can be used to follow the current market trend, and they are going to give you a lot more profit. So for example, let's say you have 20K and market goes against your direction. So instead of losing like 3-4K, right, you only lost $100 or you only lost $500 because you hedged properly. So now when the market start to goes in your direction again, right, you actually have $19,500 to play with, compared to, let's say, if you have lost $3,000-4,000, you only have $17,000 to play with. So now the capital that you manage to preserve can return you more profit in the future. So the prevented loss, right, not only is a profit gain, but it's also future profit gain, because those capital can work for you in the future. Okay, so not every trade need to give you profit. Some trade can act as a buffer during big volatile market movement. So let's take a look back at the S&P 500. So now within this period, I was able to maintain my portfolio without a huge loss. So let's say S&P kind of like goes sideways a bit. Most likely my portfolio will go sideways a bit also. Then if it continues to recover, then what I can do is I can shift my portfolio bias. I can cut my Starbucks for small loss. I can take the profit on my children place short, and then I can start adding long position into Google or other long tech position. Sorry, I sneezed again. If you see me suddenly pause, right, it's me, I'm sneezing. I was just muting the mic. Okay, let's continue. So from that position, right, I have the option to change my portfolio position as it goes above. But let's say the market decide to come all the way down, right? What I can do is I can also simply take profit on my Google and MasterCard, and then all my shorts will start to earn more money and all my Russian thing conflict will start to be in profit also. So from that perspective also, my portfolio is somewhat versatile in the current position that it is in. Of course, it is not like a sure win portfolio. There are definitely opportunity costs incurred in order to get this kind of portfolio, and that opportunity cost is that I knowingly give up the rally that I could have gotten here. Okay, so that's the opportunity cost. But of course, that was a decision made deliberately, because in terms of a risk perspective, right, I don't feel that is worth it. The risk is worth it to get a long position in here and here. But instead, I simply just add one Google position just to reduce my overall portfolio risk. So hopefully from there you can kind of look at your portfolio in a different light, in the sense that you should look at your portfolio as a whole and structure your portfolio properly. And also don't think about what the current trend is, but think a few steps ahead on what you want to do if the trend decides to change, and if your portfolio is able to change with it. So if you do not really plan ahead, right, what you can encounter is that whenever something change unexpectedly against you, you are going to hit stop loss left and right, and most often you are going to lose all the profit that you have gotten back into the market. And that's how most traders lose their profit that they earn. They lose back the profit back to the market because they are not really planning ahead. So previously during this down move, I have already made quite a bit of profit from Rivian's shorts, Snowflake shorts. We also have long position on Singapore energy counter like Rex International, Golden Energy. We do have quite a substantial amount of profit that already made here. So because of that, I don't feel the need to catch the bottom and get this rally. I just manage my portfolio into a neutral or slightly bear position. Then after that, I see how I want to follow up later on. So sometimes you can be greedy, but not too greedy also, because from a risk perspective, it's not really worth it. Okay, so next, let's go on to the yield curve, the talk about yield curve. So yield curve is a very common topic nowadays because I'm bringing it up quite often. But if you are looking at the news, Bloomberg, CNBC, I'm sure, or even other YouTube finance channel, this yield curve topic will probably pops up quite often. So why is it only popping up now and not like a few weeks back or 1 month ago? And that is because currently we are in a situation called the yield curve inversion. And yield curve inversion is not a very common situation that happens in the market. It probably happens once every very long time. And when it does happen, it has a few repercussions. There's some consequences to the yield curve inverting. And that consequence is actually recession. Whenever a yield curve inverts, we have a recession like 1 year later or 1.5 years later. It's usually delayed. The recession delay the yield curve inversion by 1 year plus like that. And later I'll show you the data also. So that's why when it is popping up now, because for a few reasons. Number one, it doesn't invert often. And when it does invert, it has huge consequence. And that's why you see it being mentioned quite a lot lately, because the yield curve is in the process of inverting, or some of the curve is, or some part of the curve is already inverted. So let's go into what I mean by inversion and flattening and all these terms. So if you look at the yield curve, I have a dashboard here. So this is actually the curve. So if you look at the past 5 month yield curve, from the red color to the green color, you can see how the curve kind of flattened. So that is what I mean by flatten. And eventually it will be inverted. So just to draw for you, right? This is a normal curve, which what you will see most of the time, which what we are seeing here. And this is a flattening curve, okay? So it's kind of like flattened already, and eventually it will inverse like this. So this is an inverted curve. So before we go and talk about the curve shape, let's talk about what this curve actually is. So welcome to the Treasury yield, US Department of Treasury. So US Department of Treasury released the yield for their Treasury bonds. So the 1 month note all the way to 30-year bond, okay? So they release this data every day. And what you do is you simply just draw the curve based on the maturity duration and the interest rate that is corresponding to the maturity duration. So typically speaking, if you buy a 1 month bond or a 1 month note, the interest rate that is paid to you is lower than, let's say, the higher maturity year, 30-year bond. So this is quite simple to understand. If I want to take a loan from a bank and I tell the bank that I'll return your loan in 30 years, they are going to charge a higher interest. The reason is that within 30 years, anything can happen. I can die, or I might lose my job, or my business bankrupt. And there is a lot more chances of me getting into business failure, because within 30 years, a lot of market recession can happen. So there's a lot of higher risk. And because of that, the bank is charging me a higher interest rate because the risk is higher. But if I go to the bank and I loan money and I say I'll return in back in like just 1 year, they are going to charge me a lot lesser interest rate, because within 1 year there's lesser risk lah. So they are carrying less risk. So you can think of it as like insurance premium lah. So if you're insured for a longer period of time, right, you are definitely paying a higher premium, because the insurance company is taking on more risk, because the longer the duration, the chances of bad thing happening to you is much higher. Okay, so that's the basic of the yield and the maturity duration. So if you plot like a normal yield, then you will get the normal curve lah. Like you see here, 1 year ago, the yellow color, this is a normal slope where all the interest rate at the lower duration level is a lot lower than the higher duration level. But currently what you are looking at is a flattened yield curve, where the lower duration interest rate are getting higher and higher and higher. And in fact, some of them are even higher than the longer duration. And if you see the process of how the yield curve invert here, right, you can kind of see the gradual process of how it invert. And from the 27th Feb to 29 March, within the past 1 month, you can see the rate of the flattening is getting higher. So what does this flattening curve represent? It represents that now your shorter maturity level interest rate are now higher, or even as high as your longer maturity level. So what does it mean? It means that let's say if I want to loan money from the bank for 1 year, the bank is charging me an interest rate as high as 30 years, or even 10 years, or even higher than the longer period. So what does it mean? It means that the bank or whoever is trying to lend you the money is expecting a lot of risk in the near term. In fact, so much more than, let's say, in the next 10 years, meaning this person, the bank feel that something bad is going to happen to you in this 1 year, and the chances of that happening is a lot higher than, let's say, in the next 10 or 30 years. Or in fact, the bank is so confident that definitely something bad is going to happen to you now. We don't even need to think about the next 10 years, next 30 years. Most likely, you're going to go bankrupt, you're going to lose your job, and most likely you won't be able to pay this money even in the next 1 year. So the market, or the bond market, the economy, the bank, they feel that the market participant, they feel that there's a lot more risk in short term compared to the long term, and that's why they are selling off the bond in the short term, which causes the yield to go up higher. Okay, so if you look from that perspective, it goes to show that the general market sentiment is there's a lot of risk short term. That's why all the short term yields are going up a lot higher than the long term yield. So eventually the yield curve can invert, the front portion of the yield curve will jump up so high that the entire yield curve will be inverted. Now it is like flattening, but soon maybe it can be inverted. So this flattening is quite common. It's quite common. You will tend to see flattening curve quite often, but the inversion is quite rare. If you start to see this invert, right, it is a sign that bad times are coming. Bad times are coming. But of course, you have to understand that the yield curve is happening in the bond market. It is not happening in the stock market. And every time a yield curve invert, right, it usually takes about 6 months, 1 year, or even 1.5 years for the stock market to kind of like catch up to what's actually going on in the bond market. So let me show you some historical time where the yield curve inverted. And one of those time is during 2019. August, September, like that. During this period, the yield curve invert. So actually there's this website here, right? I'm gonna move this line to August, September 2019. Okay, so you can see right here, it's not really a true inversion, but it is kind of like flattened, and the lower end is slightly higher, and that is somewhere around, okay, here. Okay, it's kind of slightly inverted already, and it happened around September 19, like that. Okay, September 19, September 2019. So that was somewhere around here. So you can see that after that inversion take place, right, market still continue to go up to all-time high before it start to crash down due to COVID-19. But I mean, this crash was definitely contributed by COVID-19 also. But even before COVID-19 happened, right, there are some signs from the bond market that things are not going to be very well in the coming days. So next, let's take a look at another period back in here. This is 2007, April, around March, April 2007. You can see how the curve is inverted back then. And that is 2007, somewhere here. Okay, somewhere here. And you can see that market actually continues to go up all-time high some more before it eventually crashed one and a half years later in 2008. So it does not mean that when the yield curve invert, things are immediately going to start crashing left and right. It doesn't really mean that way. It just means that maybe things are going to be happening back in the future. And in fact, for the past history of US market, right, whenever the yield curve invert, it always follow up with a recession. There have not been any exception yet, but who knows, maybe this could be the exception, no one knows. But based on past data, right, there have always been a follow-up recession after the yield curve, and that recession usually come 6 months or 1.5 years later. So that's something that I want to bring attention to you guys. And of course, also not just blindly like see things in a way where yield curve invert then recession, but also understand the mechanism why the yield curve inverting mean is a bad thing, because a lot of market sentiment, they feel that there is a lot of risk in the near term for whatever reason, and it is reflected in the bond market itself. So with that said, right, no doubt currently market is still very bullish, and it is due to the yield curve and of course some other macroeconomic factor that which I will not be going through right here, and that makes me feel a little bit wary, a little bit suspicious, and it is also because of that, and also my own personal trading strategy, that I didn't wanted to buy the bottom here, or even I didn't wanted to chase the bottom, chase the rally but rather I structure my portfolio into a more neutral position where if things continue to go up, I won't suffer any losses But one thing you have to be very careful, especially if you're a short-term trader, right, is that don't fight the price action. Because yes, sometimes we can get carried away with yield curve inflation but the thing is, these are macro fundamentals, and macro fundamentals take a lot of time to get seep into the real world economy, and then finally it will only then impact the stock market itself. Like for example, yes, inflation high, mortgage rate going up, blah blah blah, but in the near short term, right, all this thing is not going to affect the market yet. Maybe 1 week later, 1 month later, 2-3 months later, we will start to see consumer not having a lot of money, because now they have to pay more in their mortgage. Like maybe initially they were only paying like $2,000, but now they need to pay $2,500, and that is like additional $500 that they cannot spend on consumer products. And then there will be less people taking up mortgage loans because interest rate going up, and then banks are less willing to offer loans because of the yield curve inversion, and then now business cannot expand. So then eventually it will get reflected in the corporate earnings where, okay, maybe this year not many people buying iPhone already, so the earnings get guided down, or the earnings actually reduce, and only then you will start to see stock market respond and stock market start to drop left and right. But right now we are only in that initial phase of all these yield curve inversion and all these high inflation lah. We still have all the euphoria from like past 2020 and 2021, all the money printing, all these have not subsided yet. So overall, the stock market itself is still kind of like quite optimistic. And also considering that in the Q1, right, the earning result for a lot of big companies like Apple, Microsoft, Amazon, they are all very, very strong. So in a way, there is enough reason in the stock market to be bullish lah. So we don't really want to fight the price action also. And one thing I kind of take note during this rally is also in the sense that a lot of money are going into strong companies with proven earnings, and they are able to manage their business well, like Amazon, Google, Apple. So these are the kind of counters that you may want to hold if you are looking for long term. Yes, we do have a lot of those chapalang tech counters that rally up like 30%, 40%. But if you look at it on a larger time frame, right, all these bad tech counters, they are still in a long-term downtrend, and they actually have not recovered sufficient enough lah to where they were previously was. But if you look at big companies such as Microsoft, Apple, they are recovering very, very well, and they are still maintaining their uptrend. So if you look at counters like Peloton, who dropped from $100, was it $100 back then? Okay, just imagine lah, for illustration purpose. If you have a company that dropped from 90% to, sorry, from $100 to $20, it means that they actually dropped 80%. Okay, they actually dropped 80%. But if they rise from $20 back to $30, right, they actually went up by 50%. So you may think that, wow, this company recover 50%, confirm outperforming Apple or Amazon or whatever. But the thing is that from the top, they are still down by $70, which is ridiculously a lot. So even though companies like Apple, Amazon, they are only going up like 15%, 20%, which is already considered very aggressive for such a big cap counters, right? They are maintaining a lot better compared to all those very I can't think of a better word, all those nonsense tech counters that are rallying 30%, 40%. Even with high percentage rally, right, they are still very far from what they are. So don't get lured into high percentage recovery, because from a raw dollar value perspective, right, they are still very far off from what they are. So we can see that during this period, a lot of funds are going into these big tech companies with proven earnings, and probably when one day when market decide to go back into the bullish mode, right, these are probably the kind of counters that will continue to go up. Okay, so even way before the market crash in January, sometime even in December or early Jan, right, we have always been recommending these counters, that these Apple, Microsoft, and Google, these are the three counters that you will probably want to enter and want to hold if you are expecting any kind of market retracement or huge market drop lah. Because these are the counter that will survive, and these are the counter that will recover. Okay, so we have come to end of this session. I think a lot of information, but I also want to share from my portfolio perspective to sort of let you know that just because you are in a bullish sentiment doesn't mean you need to fight the price action. It also doesn't mean that you just short everything that you see. You can even go long position on certain counter to buffer yourself. So it does truly depend from trader to trader how they position your portfolio, how they manage their risk. For example, there will definitely be successful trader who, based on their own risk management, they decide to take the bottom. And if you are those kind of trader and manage to profit very well during this rally, right? I mean, it's very good for you. Huge congratulations. And I'm sure you have your own strategy that you are playing with. But overall, you want to have a plan, and you do not want to be just blindly following the trend without any plan for the future, or having no idea what to do should market suddenly come back down. Okay, so make sure you have a plan, you structure your portfolio properly, make sure you are on top of your risk management, and you should be fine during this period when things are slightly more crazy. We are still in a very crazy market that we have been back in early January. Okay, so have a great day, everyone, and take care.